Hello friends. Friends, we'll continue with our discussion on cash flow statement. Right? So in cash flow statement, we have discussed about what is a cash flow statement. Then we started with cash flow statement for operating activities. We prepare cash flow statement with three activities: operating, investing and financing. And we have started with cash flow from operating activities. Right? So what is an operating activity? Any activity relating to the routine operations of the business is an operating activity. So while calculating the cash flow from operating activities, we have to consider two things. One is whether that activity is relating to the routine operations of the business or not. Right? Number two is whether that activity is involving the actual cash outflow and actual cash inflow. Right? So we have to consider two things, that whether an activity is an operating activity or not. Second, whether the activity is involving the actual outflow or inflow of cash or not. Right? Then in the last lecture, we started with the steps. And the step one was calculation of net profits before taxes and extraordinary item. Right? In this, I told you that we prepare profit and loss account. And from the profit and loss account, you all know what figure we get is, we call it as net profit. Right? On that net profit, we pay taxes. Right? We pay tax, and whatever is left is the income that is coming to our pocket. Now, what is given to us is net profit after tax, and we have to reach at the net profits that we attain, that we get in the profit and loss account. Clear? So we will be given is net profits. I'm discussing case 1. Okay, net profits after tax. Right? Tell me the items that are to be added back. Extraordinary expenses, because these expenses are not related to the ordinary operations of the business, not related to the routine operations of the business, but these extraordinary expenses must have been debited in the profit and loss account. Now we will add back these extraordinary expenses, and we will add back provision for taxation of current year only. For the current year, we set aside some amount out of the profits to pay for taxes. We have created a provision for taxation. Right? Why we are adding back provision for taxation? Because there is no actual cash outflow or inflow from this provision. You have 100 rupees in your pocket and you are creating a provision in your mind that you have to spend rupees 50 tomorrow on buying a notebook. But it is not involving the actual cash outflow while you are creating a provision today. You might spend tomorrow, right? That will involve the actual cash outflow. But today you are only creating a provision in your mind. So that is not your cash outflow or cash inflow. Right? Clear? Now, what are the items that are to be subtracted? If we say the extraordinary expense we are adding back because it was debited to profit and loss account, then there might be an extraordinary income also, which would have been credited to the profit and loss account. So we will subtract it. We would have added that income in our profits, but that income is not related to our routine operations of the business. So we can't take that income into our profits. That are not our profits from operating activities. Right? So I will say, I will subtract any extraordinary income. Right? Why we are subtracting this extraordinary income? Because this income is not related to the routine operations of the business. Right? And we will subtract refund of tax. Refund of taxes we will add back, because again these are not going to affect my routine operations of the business. Right? So whatever we get is net profit before taxes and extraordinary items. Right? Clear? This was case 1, and in this case 2 is also covered when net profits before taxes are given. In that case you will not take provision for taxation. That's it. Right? Now we will move on to case 3. Right? Now what is case 3? Just tell me one thing. You are having rupees 100 in your wallet. What you do is you take 100 rupees out of your wallet and keep it in your pocket. Right? You take out 100 rupees from your wallet, you keep it in your pocket. Is there any cash outflow? Is there any actual cash outflow or inflow? You take out the money from the wallet, keep it in your pocket. You still have 100 rupees. Isn't it? Whether that 100 rupees is lying in your wallet or it is in your pocket doesn't make a difference. You still have rupees 100 to spend, whether it is in your wallet or in pocket. Same is the case here. What business people do is, when we earn profits, we transfer some amount to reserves. Why these reserves are created? These reserves are created to meet any future contingencies relating to business. We have profits, right? What we decide is, let's keep some amount of those profits as reserves, so that in future, if a business face any problem, we can use this reserve, right? What is left with us? We can call as surplus, right? Surplus is what? Nothing but profit only, isn't it? Okay. You have 500 rupees in your wallet, right? Out of this, you take out 100 rupees and keep it in your pocket. Now, how much total money you have to spend? You still have 500 rupees with you. You can't say that I have 400 rupees in my wallet, so I have 400 only. 100 rupees is in your pocket also. So you still have 500 rupees. The third case is, you will be given reserves and surplus. You will be given this figure, right? What will be given is reserves and surplus, right? You will be given as reserves and surplus, this amount. Now, if you see, we have to reach at these profits first. These are profits after tax. So from the surplus amount, we have to reach at this profits. What will I do is I will add back reserves. I will say I will add back any amount that has been transferred to reserves. I will add back transfer to reserves. Clear? Because I have to first reach at the profits after tax. After that, I will add and subtract these items. Right? Now, what has happened is this reserves and surplus is the amount that is lying in the pocket. Right? So, you say you have 400 in your pocket. Then you find out that you have you have 400 in your wallet. This is your wallet. Then when you checked, you find out that you have 100 in your pocket. So what is the total amount you have? 500. Similarly, we have reserves and surplus. We add back transfer to reserves. What we get is profits after taxes. Because the reserves would be created out of the profits after taxes only, right? Whatever the actual amount is coming to our pocket, we will create the reserves out of that only, right? So these are profits after taxes. Now you know what you have to add and subtract. You have to add any extraordinary expense which has been debited to profit and loss account. Add back any extraordinary expense debited to profit and loss account. Clear? Add back provision for taxation current year. In the current year, whatever provision you have created, you have to add that back. Because that is just a provision. It is not involving any actual cash outflow or inflow. Right? You are creating a provision in the mind that you have to spend rupees 50, but you haven't spent that yet. You still have rupees 100 in your pocket. So I will add back any provision for taxation created for current year. Remember this. It is for current year provision that is to be added. Right? Then I will add here two more things. One is proposed dividend, right, and interim dividend. Now, what is proposed dividend? To whom the dividend is payable? First of all, the dividend is paid to the shareholders of the company, and this dividend is paid out of the profits of the company. Right? Now, what has happened is during the year, you proposed a dividend at a certain rate. During the year, you held a meeting with your shareholders, right? And you tell them that I will pay you dividend out of the profits at the end of the year. I will pay you dividends at the end of the year. But during the current year, when you are preparing the cash flow statements, during the current year, when you are preparing the cash flow statement, you have a proposed dividend, but not and what is the actual dividend paid? See, the actual dividend paid will obviously depend upon the amount of profits you earn. If because of some reason you do not earn the profits that year, will you pay the dividend? You can't pay the dividend because you don't have profits. So it is just a proposal to pay the dividend if we earn the profits this year. It is just a proposal to pay the dividend. Is there any actual cash outflow? Are we actually paying dividend at this stage? No, we are just proposing to pay the dividend. Right? Clear? So there is no actual cash outflow. That's why we are adding this back in the net profits after taxes. Now, if we talk of interim dividend is paid during the year to the shareholders. Now, you will say, sir, interim dividend is involving the actual cash outflow. I agree. Interim dividend we have paid. Interim dividend is during the year we have paid the dividend to the shareholders. Right? We see that we have the profits during the year, we pay the interim dividend. In between. Interim is in between. That is, during the year we pay the dividend to the shareholders. Right? So you will say, sir, this involves the actual cash outflow, so why are we adding back? In the very beginning, I told you to consider two conditions basically. One is whether the activity is involving the actual cash outflow or inflow or not. Yes, sir, it is involving an actual cash outflow. Second condition, is that activity relating to the routine operations of the business? Paying interim dividend will affect the routine operations of the business or not? Interim dividend is not an activity which will affect the routine operations of the business, which is related to the routine operations of the business. So interim dividend is not at all an operating activity. Clear? Just remember these two conditions. This interim dividend is not an operating activity. Now you will ask, sir, then which activity is this? This we will do later on. It is a financing activity. Right? This we will do later on. So we will add back an item which was deducted in the profit and loss account, because interim dividend paid is an expense. You must have subtracted it out of the profits, but it is not an operating income. It is not, operating activity. So I will add back this item in the profits. Right? So these are the items that are to be added back. Transfer to reserves, any extraordinary expenses debited to profit and loss account, provision for taxation created for current year, then proposed dividend. This proposed dividend is also for current year. These two items are to be dealt with very carefully. These two are for current year. Only the current year amount is to be added back. Be careful about this. Okay. Now, what is to be subtracted? Can you tell me? Very simple. Any extraordinary income. Any extraordinary income we will subtract, and any refund of taxes. Right? Because this is not an income relating to the routine operations of business. Now this is what we get as net profit before taxes and extraordinary items. You have to just see the items which are related to profits, right? Provision for taxation is related to profits. So we will deal with while calculating the profits. Proposed dividend is paid on profits. So we will deal with it while calculating the profits. Interim dividend, again dealing with profits. Refund of taxes, again dealing with the profits. Any extraordinary expense income, that will affect the profits. Right? So what we get here is net profit before taxes and extraordinary item. So this is how you deal with it if you are given the balance of reserves and surplus. Right? This is reserves and surplus. We will add back any transfer to reserves because reserves are nothing but the part of profits only that we have kept aside for future. But right now this is a part of profits only. Right? Then what we get is profit after taxes. Right? Now you know you have to add something and you have to subtract something out of the profits after taxes to reach at net profit before taxes and extraordinary items. Right? Clear, friends? So provision for taxation is added because it does not involve any actual cash outflow. Proposed dividend, it is just a proposal as of now. We haven't paid the dividend, so there is no actual cash outflow. We will add back any proposed dividend. Then we have interim dividend. Interim dividend involves actual cash outflow, but it is not an operating activity. It is not related to the routine operations of the business, so we will add back any interim dividend paid during the year. What is to be subtracted? Any extraordinary income, any refund of taxes, because this does not relate to the routine operations of the business. Just remember these two conditions, whether an activity is an operating activity or not. Clear? That means whether that activity is related to the routine operations of the business or not. The second condition is whether that activity involves actual cash outflow or inflow or not. Just remember these two conditions and you will be easily able to identify the items which are to be considered in operating activities. Clear? So let's see a small practical problem on this. Okay. So you are given the balance sheet. You are given the balance sheet as at 31st March 2015 and 31st of March 2016. Right? He says equity and liabilities, shareholders funds, share capital we are given. Then we are given is reserves and surplus. What is the current year reserves? 3,30,000. Last year it was 2,20,000. That is reserves and surplus means the surplus that is balance in statement of profit and loss. Right? Non-current liabilities, long-term borrowings, 10% debentures. Current liabilities, short-term borrowings, trade payables, short-term provisions. On the asset side, he says we have the non-current asset, fixed asset, investments, current assets we have. Then notes to accounts. They say there were short-term provisions include proposed dividend of 90,000 this year, 60,000 last year. Then provision for taxation current year 70,000 and 40,000 for last year. Clear? Now you have to calculate, what you have to calculate is net profit before taxes and extraordinary items. You are given this reserves and surplus. Right? So we'll start with reserves and surplus. You can pause the video here and you can try on your own. Okay. So what is the amount of reserves and surplus? What is the current year amount of reserves and surplus? In the current year, we have a surplus of 3,30,000. Right? Then what we add back is any transfer to reserves. Do you have any transfer to reserves? right? Do you find any amount that we say we have a general reserve or something else? No, we don't have any other reserves on the liability side. So this amount is, so what it means, we do not have any amount here. So this means we have profits after taxes of 3,30,000. Now out of this, what is to be added back? See the items that are to be added back. Long-term borrowings, no. Short-term borrowings, no. Trade payables, no. Short-term provisions, no. Assets, no. Current assets, no. Notes to accounts. Proposed dividend, yes. Provision for taxation, yes. Which amount? 60,000, 40,000 or 90,000, 70,000? Which item is to be considered for this purpose? Just tell me. Which item? Sorry. One point I have left here is we have to identify what is the surplus earned during the year, right? This one point I missed out is, if you have the balance sheet for the last year, here we are given the two balance sheets, right? We are given at the end of 31st March, we have the reserves and surplus of 2,20,000. And at the end of 31st March, we have the surplus of 3,30,000. So can you tell me what is the surplus earned this year? We have to take the profits of this year only, right? So how to calculate this is, I will say, what is the closing balance? What is the closing balance of reserves and surplus? It is 3,30,000. I will subtract the opening balance of reserves and surplus, 2,20,000. Now this amount, this is the amount that I have earned this year. This is the amount of surplus during the current year, because I have the surplus at the end of the year. I have the surplus in the beginning of the year. If I subtract these two things, I will get what is the surplus earned during the year, right? This is the surplus during year. Now in this, I will add back any transfer to reserve. Do you have any transfer to reserves? No, right? So what is your profits after taxes? This comes to 1,10,000. Clear? Now what is to be added back? We have two things to add back, that is proposed dividend and provision for taxation, right? Why we are adding back this? Because both these transactions do not involve the actual cash outflow, right? Therefore we will add back these. Now can you tell me what will be the amount to be added back for proposed dividend? I just told you which amounts are to be considered. Only the current year figures are to be added back. So what are the current year figures? 31st March 2016. So for the current year, we have created a provision of 90,000 and provision of tax for 70,000. So what is the amount that will be added? This will be proposed dividend of 90,000 and provision of taxation for 70,000, right? So this total comes to 2,70,000. This is our net profit before, we do not have any extraordinary items here, right? And extraordinary items. Clear? So this is how we are going to calculate the net profit before taxes and extraordinary items. If we are given the balances of reserves for the 2 years, we will find out what is the balance of reserves that is earned this year, right? Then we will add back any amount that is transferred to reserves. If there is any general reserve or any other reserve appearing in the balance sheet on the liability side, we will add back that amount of reserves, right? Then we will get as profits after taxes. After that, you know what items are to be added and what is to be subtracted. Just see what all items you have. Clear? Now you might ask, if you see the question, you might ask me, sir, what is the relevance of these two amounts, 60,000 and 40,000? Friends, this was dividend proposed last year. Last year, they proposed a dividend of 60,000. Now, this dividend might have been paid this year. If you find out that you have profits at the beginning of the year, then you will pay this dividend of 60,000 this year, right? Similarly, you have created a provision of taxation for 40,000 on 31st of March 2015. After that, we finalize the accounts and you find out that you have to pay a tax of 40,000. So you will use this provision, this 40,000, this is the actual cash outflow in the current year, right? See, on 31st of March 2015, you created a provision for taxation of 40,000. Now on 31st of March 2015, you close your books, right? Your new period starts from 1/4/15 to 31/3/16. Now you are closing your books on 31st of March 2015 and you will pay tax after this date. After this date starts our next accounting period. So the payment of tax, that is actual cash outflow, will happen in current year, right? So you might ask, sir, then if this is involving an actual cash outflow, then why we are not considering while preparing the cash flow from operating activities? Remember the two conditions. It is involving an actual cash outflow, but is paying tax related to the operations of the business? Is it an expense which is related to the operations of the business, which is directly related to the operations of the business? No. The answer is no. That's why we are not considering this 40,000 here. So then where this will be treated? This will be treated in financing activities. This we will discuss when we will move on to financing activities. Clear? The same is the case with proposed dividend. Okay. So you can write this down. Just be careful with this surplus balance. If you have the two balance sheets, so you have to calculate the surplus earned during the year. For that, you will say closing balance of reserves and surplus minus the opening balance of reserves and surplus. That will be the surplus that you have earned this year, right? And just be careful with the items that are to be added back and subtracted, right? I have tried my best to explain you why that item is adding. We are adding back the items and why we are subtracting these items, right? Still, if you have any queries, you can always email me at ksjteaching@gmail.com. Okay, friends. So in the next lecture, we will move on to step 2 in calculation of cash flow from operating activities. I hope you are very much clear with step 1, right? Calculation of net profit before taxes and extraordinary items. Now in the next lecture, we will move on to calculation of step 2 in calculation of cash flow from operating activities, right? So that's all for this lecture, friends. Thank you so much.